No, individually. Okay, so those were the top 40 stock. Jerry, give me a minute. Hey, Jerry, what's happening? So pick one of the 40 stock markets. You can pick other stock markets too. Pick one, and this is the one you're going to be tracking the rest of the semester. Okay? So you get online, go find the stock exchange, learn about the stock exchange, how big is the market cap, how many companies are there, what are the type of companies, what's the industry concentration, how's the index calculated, is the index up or down, is it trending up or down, what do you think the Venezuelan stock exchange index has been doing? Probably crashed again, right? There's Japan, obviously we have Tokyo, we have Singapore, we got Beijing, we got Berlin, we got Paris, we got Colombia, we got Argentina, we got Buenos Aires, we got somebody I'll let somebody do the NYSE, okay? Just as a benchmark, do you think that the global stock markets are highly correlated or somewhat correlated to the New York Stock Exchange Index? Yes and no. It'd be interesting to see if there is correlation or inverse correlation, or because the key to building a global portfolio of equities and even bonds or even assets on a global basis is really international diversification. So you're getting currency diversifications, you're getting economic cycle diversification. Theoretically, you should be able to bow out the efficient frontier within your portfolio by building a global portfolio. We talked about that in 123. We talked about that in 136. The global portfolio construction is basically the same methodology. By building a global portfolio of equities and or fixed income and or equities, fixed income, currencies, you're going to get diversification across the asset classes, and you're going to get diversification across the different countries based off their institutional structures, their politics, their industrial policy, and then the industries that make up a high concentration of whatever the comparative advantage is for that individual country. Will basically show you where their comparative advantages are based on the industry concentrations within the stock market, their stock markets themselves. Why would they privatize their national companies and actually establish a free-floating exchange of equities of their own countries? Why would they develop a stock market? Why would countries develop a stock market?
Increase investment.
Exactly. So they want capital flows into those companies to be able to issue stocks, take that global investment, and to be able to deploy it in plant and equipment or other types of productive assets to grow earnings, and then raise wealth and living standards based on participation within the equity markets. A lot of these countries don't have 401ks, don't have self-directed IRAs. A lot of these countries, a majority, just like here, the majority of the population, particularly here in the United States, the majority of the people do not own equities, do not participate in the equity market. I think that's one of the biggest problems in economic development, not only here but also globally, is that you don't have mass participation within the equity markets on a global basis, spread out around the middle class and other people at lower classes within the population. So it's the developing stock markets are really, really interesting. There's a paper on it that I wrote online. If you want to cross-check your exchanges that you've picked with the exchanges that are talked about within these books, you can come up, you can use these books, and you can take pictures of the chapters related to your exchanges. Or you can look through these books and get an idea of what exchanges you want to track. So I'm just going to pass these around, take pictures if you're interested. There's probably other books that have been published since I pulled these books together. I don't know if we have them in the library. You might be able to get them online. But take a look at it, find your exchange, become an expert in it, track it, and then give us an update. Not every class, but track it. What else? The problems that I handed out. I'll do this every Wednesday. I will hand you out these problems basically associated with the book. The book's over there if you need to take pictures of the questions, you can do that. And then on Wednesday next week, you're going to come in and boom, everybody's going to the board, everybody's writing on the board. You're writing up the maybe a high level points of the question and then the solution. If the problem is multi-stepped and too complex for your brain to handle, then you can work in teams to solve it. Most of them are pretty easy, but later on when we get through the book, we start getting into some pretty complex stuff. So again, Mondays, lab, okay, you're working on your projects. Wednesday, problems. Friday, presentations. Okay? All right, and then we'll get into kind of a rhythm. Here is some examples. I think I posted them online. Some resume samples. So for anybody who doesn't have a resume, you need to get me a resume as soon as possible. Here's some resume samples. I work with Mary Beth. Get that thing checked off so that we can start working with you to get you placed in internships and jobs. Here are some samples. You're going to be picking a bank that you're going to be doing your intrinsic valuation on. For those who did 123, you have a good idea of the quality of the intrinsic valuation that you will be doing. For those who haven't taken any of my classes, this is the product that you will be producing at this level. So I would make sure that when you form your teams, that you have at least somebody who has taken my either investments or my 123 class, or work in subgroups where you can use the other groups and the other individuals as a resource to answer a lot of your questions, okay? And again, you should start thinking about what bank you and your team want to analyze, and you should tell me what it is. Okay, tell me what bank it is. Don't use a U.S. bank. You know, like Santander out of Spain. What is it? BNP Paribas out of Paris. Either Deutsche out of Germany. And if you do Deutsche out of Germany, we need to work together because that bank is a total basket case. Credit Suisse, UBS, those are all examples. Bank of Tokyo, Bank of China. Be careful if you do want to do Bank of China. I don't know how much transparency they actually have, and if they even adhere to international GAAP standards in their reporting. So you got to be really careful when you do these things. Did I hand out the Finance Club forms? All of you did? Okay, did all of you hand those in? Did all of you fill it out? I think I only got 3. Okay, I need all of you to fill them out. Does anybody not have the forms to fill out? Fill them out. Make sure you bring all of your notes. Make sure you bring everything to class so that you can refer them. Don't forget your backpack. Don't forget all of your notes underneath your bed. Don't forget your notes at your friend's house. You know, bring your notes to class. Who is interested in the SIE exam? Does everybody know what the SIE exam is? Yes? No? Yes? No? Yes? No? Okay. Here's an example of the SIE exam. I have some handouts here to give you if you're interested. Basically, it's the first level of the Series 7, which is sponsored and given by FINRA, which is the organization. Jerry, I can't talk. It's really disruptive when you're talking. So here's what I would do, Jerry. This is some advice. If you guys want to talk to each other, you know, get really close to each other and whisper in each other's ear. Okay, that way it doesn't distract me. Okay, so you guys can talk to each other but whisper oh so lightly in each other's ears. Okay, I appreciate that. So the SIE is the first level exam. It's basically provided by FINRA, which is the self-regulatory agency for the securities industry. If you're going to work for a broker-dealer, investment advisor, a bank, in their investment division, if you're going to be trading securities in any way whatsoever, you probably need the SIE. Okay, if you're going to go into marketing at Schwab or any of these companies, you need the SIE, and you probably need the Series 7 too. So they're making almost everybody who's involved in the industry to take and pass the SIE as basically a first level competency check on you, because it's a standardized test. Okay, the education is not standardized across all colleges, so they really don't know the quality, you know, of content in which you were learning within your programs. But the SIE is a standardized test, like the CFA exam, which basically means that if you pass any of those exams, they know what level your competencies are. Okay? So anybody can take the SIE. So AXA Insurance Advisors basically sponsored this licensing for us to get us the discount on it. And I will probably do a webinar and have them do a thing for us to give you a little bit more education on it. But I highly recommend that you take the exam, okay, as soon as possible. Take the SIE, okay, it's only $116 plus tax. Sam, how did you ace the SIE? How'd you do it?
I just studied for like a month and a half out of the book. There's like an online portal.
Yep.
You could like
Which is
follow
right
along.
there.
Yeah, and it's just, the online portal was really helpful to be able to take the practice test once I felt ready. But there's like a schedule in the book too that you can follow, and I just followed one of those that I felt most comfortable with.
Excellent. Okay. So I highly recommend getting that, or get your real estate agency license, or your insurance license. Get any of that stuff, okay? Any of it, all of it. It'll make your life so much easier when you go to interview. It'll make your life so much easier because you'll probably get the job over other people. AXA Advisors basically said that if you guys pass the exam, they will hire you as an intern paid, and they will hire you right off the bat as an investment advisor. Do I want to be an investment advisor? No, I don't want to be an investment advisor, but I can't get the job that I really want right out of college, so I'm going to go be an investment advisor for maybe a year or two. During the 2 years that I'm an investment advisor, I'm meeting probably 25 people a week. Okay, I'm meeting about 100 people a month. So that over basically 2 years, I've got basically a couple thousand people that I've talked to. Of those 2,000 people, they're probably going to be impressed with you some way or another, and they're going to offer you a job. So if you hate being an investment advisor, you'll probably find another job someplace else. It's a great place to get in, great training. It's a great start. If you love it, great. It's a great career. If you don't love it, you got to do the work. It's painful, big deal. You'll get a better opportunity at some point in time in the future. Your first job out of college is not your last job out of college. It's just the first. So be open-minded. You know, take the best opportunity presented to you. What else? Anybody want to take a look at the? I'll pass this around. This is basically the deck. You're going to be doing 8 basically profiles, fact sheets on stock and bond markets. 2 established markets, 2 emerging markets, for the stock markets and the bond markets. Here are examples that were done last year by your student colleagues. They basically set the template for you, so you can pick an exchange and update the data. Okay, so I'm trying to save you a lot of time so that we can move through a lot of material. I know it's quote unquote busy work from what I've heard from a lot of people, but again, it's being able to see different types of formats, to be able to do the research, update the data, all hands-on, so that then you can use that as another sample of your work when you're interviewing in an internship or a job to show them the kind of work that you can do. Okay? This is what I did in my classes. Okay? All right. Anybody interested in these iShare fact sheets? These will come in really valuable later on in the class when we start building fixed income and start building country level. We're going to basically create our own fund of funds, okay, out of these iShare ETFs. Okay, and I'll show you how we're going to do that a little bit later. I already gave you the quiz. Anybody who wasn't here and didn't get the quiz, here's the quiz. This is basically, it's the same thing as the quiz. The quiz in 123 is basically the last part of the pretest in this class. I took that last part of the pretest and I basically made it a global context. So the pretest is basically the stuff that you've already done. I'll go over it again, particularly the last part of the pretest, because I'm convinced that a lot of you have forgotten the majority of the stuff that I taught you over the last year or two. So you need a refresher on the fundamentals. And then what we'll do is the quiz will basically be the same thing on the pretest, but from a global perspective. Okay. All right. I already handed out the homework problems. Anybody not get a statistical pretest? It's all, you got my last one, so maybe you can print print out the syllabus and print out the pretest and then give it back to me, so I have copies of it, just so that you can see what it looks like.
Do you want me to just copy them and bring it back?
Yeah, exactly. All right. We already gave out the problems. Did anybody, or was anybody interested in perusing through the deliverable packages, so you can see exactly, what we're gonna be covering and what other people have done in the past? Again, I'm trying to save you a bunch of time instead of struggling to build this stuff. I know Mason struggled to build the deliverable packages and investments. Does it help to look at models?
Yeah. Yeah.
Anybody want to take a look at the global memos? The global memos, okay? Basically, they're the same memos that you wrote in 123, but from a global perspective, okay? Anybody want to take a look at these? Take pictures of them and then update them, okay? What I do is I basically will copy the memos and then update the data and the analysis. Maybe you changed your perspective on what direction global stocks are going to go. I think that, what do you think? Do you think global stocks are going to go up or down over the next year? Probably down, right? Because most of the countries, particularly emerging markets, are in recession, right? So that trend will probably continue unless the U.S. comes screaming back or China comes screaming back. I don't think China's going to be coming screaming back, and I think the U.S. is in a cyclical downturn. The early indications of a recession are already taking place, okay? What I also want to do, and here's an example of the international bank stock valuations that were done a year ago. So I handed out the domestic bank stock. Here's the international, if anybody wants to look at it. So I'm going to hand it around. And don't leave this stuff when you leave today. The class, don't leave my material on the desk. So I got to walk around and clean it up. Just put it all together, give it back to me, throw it in the box, so I don't have to walk around and get it. What else? What I want to do, I don't think I'm going to be able to do it today. Maybe I can do it on Friday. But I think it was yesterday or the day before, Kyle Bass from Hyman Capital Management, the guy who basically made $250 million shorting the mortgage market during the financial crisis. The guy's absolutely brilliant. He basically tracks China and Japan. He was interviewed on Bloomberg TV, so I may actually go dig that out and try to get her early so we can watch it on Friday before we do the presentation. I want you to listen to how this guy talks, okay? Because I want you to replicate. I want him to be your model, because this guy is unbelievable. When he speaks, he integrates and brings in so many multidimensional perspectives of the global market and articulates them perfectly in his oration. He can move from sociology to technology to cognitive psychology to fiscal and monetary policy, macroeconomics, microeconomics, capital markets, currencies, bond markets, fixed income, human behavior, population, sociology. The guy intertwines everything within his advisory firm. It's a very large private equity firm. It's a hedge fund. There's no information really on the firm. I'm going to ask you to do the research and try to find out as much as you can about this guy, okay? and the company. Kyle Bass is the guy's name, okay? And one of the questions, I will give you on the midterm and stuff like that, I will give you these worksheets, and they're basically take-home stuff, and you go do the research and you fill these things out, okay? So this course is just a lot of research. You're constantly researching, okay? Instead of me getting up here and speaking for 3 hours a week and having you, retain less than 10% of the content, which is usually what it is in a Socratic method of teaching, I think those days are over. It's team-based, it's research-based, it's product development. That's the way the top graduate schools are teaching. And then the last thing you're going to do, which I would love to have you do probably as soon as possible, is to start, and I'm going to hand these out. So this is basically a worksheet. Okay. It's a double-sided worksheet. Okay. I probably should do this in every single class. It's a double-sided worksheet. You go find a peer-reviewed journal article in the library from one of these reputable peer-reviewed journals, okay? And you go find an article, okay, that basically talks about what are the factors that drive currency values? What are the factors that drive global stock prices? What are the factors that drive global bond prices? You know, that currencies, global equities, global bonds, okay? Or maybe even global capital budgeting. How do multinational corporations make decisions on where to build a plant and how they make that investment decision, right? What are the factors that they look at before they invest in another country, particularly a foreign country? So here are the journals. I'll pass this around. Those are the worksheets over there. There's also more worksheets up on the website. You're going to probably do at least a few of these, because I want you to learn how to go to the library. How many people have read a peer-reviewed journal article? How many people have ever, raise your hands. How many have read one? Okay, so a lot of you haven't. Okay, so probably 25, 30% of the people have not read a peer-reviewed journal article. There's a methodology to reading these articles so that you can quickly pull out what the research objectives were, what was the problem that they were solving, where did they get the data, what was the structure of the model, what were the factors that were identified in the model that basically were able to predict what the dependent variable is. Okay? So once you start learning how to read these peer-reviewed journal articles, that will basically be the basis of your research paper, which we're not going to do in this class. But you may have to do a research paper at some point in time in the future, particularly when you go to grad school, if you haven't done it already. And you're going to have to search through the literature, search through the theory, search through the peer-reviewed journal articles for external validity, and to be able to use those peer-reviewed journal articles as basically the basis for citations for your research. Okay? We do that a lot, okay, in business, especially when I'm doing white papers and building new product. They want to know who's done it before in the past, how did it work, what were the factors, can you give me some external validation associated with your approach, okay, and your results, okay? All right, so today is Wednesday, all right. Why don't we, since we're not doing problems this week, why don't we go through the pretest, okay, and why don't we go through the pretest as quickly as possible to guide you, to get you jump started. Huh? No? Can you go up onto the website and print it out over there? Can you print me one too? Because I think I gave all of mine. Did I hand out the Financial Times last time? Yeah. Did I hand out The Economist? Eleanor, were you going to print me one too? Okay, thank you, I appreciate it. Sam's already done it. Can you approve? No? You remember this, Billy? You probably shredded that. Good bag. Makes it a little bit easier. Do you still have yours from last time? Okay, before we do the pretest, why don't we go around really quickly and tell me the stock markets, and just one or two comments on the stock markets. Why don't you lead us off, Eric, on the stock market? Of course, anybody can do the stock market. Just start
The
talking.
one that we picked?
Yeah.
The S&P 500 is up
It
8.56.
has to be an international.
Oh,
And then just speak up. We're not gonna go around in order. Just, if you've already done the research, you know what the stock market you're doing, you have some data on it, and you know why it's gone up or down, just tell me about it really quickly, just in one or two sentences.
The German market's down,
Is that out of Berlin?
9%.
Is it Berlin? Because
I
Germany's a really big country. They may have more than one stock market. Okay, next.
The Australian Securities Exchange is up 17%.
Okay, excellent. And then anything driving the news or the markets over there, if you can give me a little comment, and then next time I'm gonna ask you the size of the stock market, what its market cap is, what its industry concentration is, and what some of the major companies that make up the exchange. Okay, next. No dead silence. We just got, come on.
Yeah, Wiener Börse
Speak up.
the Wiener Börse is down
Okay,
about
what's that? Is that a German
0.7.
exchange?
No, that's Austrian.
Okay, yeah, tell me the country and then the exchange and then tell me what's going on. Really quick.
So the Austrian Wiener Börse is down about 0.7%, and there is no supposed reason.
Okay, that's fine. Next. This should be really, really quick, right? We're simulating basically a trading room, basically giving me, it's 4 o'clock in the morning, we open at 6, New York time, this is the debriefing, this is an international, basically stock market update. You're giving me, the managing director, Derivative Trading Corporation, basically an international perspective of what's going on in the global markets next. Go.
Japan stock market is up by
Japan's a big country. Are we talking Tokyo or?
Nikkei 225.
Okay, so it's out of, it's Tokyo?
Yeah.
Is it up or down?
It's up
Okay,
1.34.
any reason why?
It says because the yen's weaker right now, so demand for auto windows are
Got it, so the yen's basically depreciated, which is increasing the exports. Excellent, next. Just yell out,
I also
Did you, okay. Any other insights? Okay, next. No dead silence,
I'm
go.
looking at the Korean
So
stock
we should,
exchange.
see what happens is when you guys get in the real world, this is what's gonna happen. You're gonna be talking and somebody's gonna talk over you, okay? Or so you're getting, get ready to say something and somebody's gonna interject. You gotta be ready for that, okay? Go, Sam.
The Korean stock exchange is up with the Korean Composite Stock Price Index, and this is because of a better risk appetite with eased political uncertainties from the United States.
I love it, next.
The Hong Kong market is up 1.16%. It apparently looks to keep running up due to people investing a lot.
Okay, this is your first time, so as we do more, you'll be really better. That was great, thank you. Next. No silence.
The Shanghai Stock Exchange.
What is it, Shanghai?
Yeah, it was up 49 points. Their market capitalization's 5.5 trillion. And they just finished the weekend for Lunar New Year, I believe.
Yeah, that's right.
But
So there was a lot of pent-up demand probably, and people were holding off on their trades until today. Okay, excellent, next. And watch out for those Asian stock markets, particularly the Shanghai, was extremely volatile because of the China situation, the trade wars and the recession basically, so a lot of volatility in the Shanghai exchange.
The Singapore exchange has fallen by 14% since the end of 2014, due to a smaller pool of domestic companies, comparative to China.
Well, then what we're gonna do is after we go through this exercise, then I'm gonna ask you, where do you think it's gonna go, right? And then once you get the opinion of where you think these stock exchanges and these stock markets are gonna go, can we trade derivatives off those indexes? Yep, absolutely. Next.
In Mexico, the BMV is up 1.2% because 3 of the bigger companies posted earnings of went up like 3 or 4% each.
And didn't Trump just meet with the Mexican president or something like that, or was
That
it?
was like a couple weeks ago.
Yeah, they went down there. Mexico's another highly volatile market just because of the level of corruption and gang activity. It makes it a little bit, but it is an emerging market, so it's really hard to kind of tell what's going on, but continue to do the research. Next. Next, hello? Anybody, hello? Anybody home? Anybody home?
Adding on to the Shanghai market, bullish market moves approach, and China's index closed at 3.5% higher than Shenzhen for the second straight session since October.
Excellent, keep going. Next time, give me more next time. Excellent, nice job. Next.
Euronext Paris is up 1.7 points, and it's they're planning to obtain Oslo Bar's EPS as a holding. So it's
Oh, they're gonna merge?
yeah, they're gonna merge.
Okay, nice, excellent, great job. Next.
The Swiss exchange is up 0.4% because of positive key trading. Quote.
Yeah, the Swiss is really interesting because what's really fascinating is the Swiss currency has appreciated significantly over the last 3 to 5 years, even though the Swiss are offering negative interest rates on their bonds because massive capital flows were coming out of Russia and out of Eastern Europe into the Swiss banking system and through the economy. So really fascinating dynamics. Continue to do the research. It's a really interesting dynamic. Next. Come on. I'm going to run out of time. Eleanor, what do you got? Speak up. Okay, next.
I had some different news on the Australian ASX 200.
Okay.
It's slightly down.
Okay.
There were some losses in healthcare and telecoms that contributed to that.
Okay. I think Australia is the only country that has not experienced a recession in the last 30 years.
Yeah, we are flying pretty high right now.
Yeah, the problem is that as China actually slowed significantly, it's kind of pulled Australia down too. And is Australia right now in their summer or their winter? It's in the summer. And what's been happening during the summer in Australia? Massive droughts, burning everything up. Major global warming situation down there. Really hard to manage global warming and massive droughts. Okay, so you got to watch Australia. Okay, the droughts will probably have a major economic impact on them. This is the first time ever that this has happened to them at this degree. 120, 140 degree weather down there torches everything. Okay, next.
The FTSE index.
FTSE?
Is the London.
Yeah, excellent.
It's up 0.8, just surrounding the anticipation around the Brexit vote.
Yeah, people are freaking out about Brexit. Freaking out about Brexit. They're already forecasting that it will have a major global impact if they do a hard Brexit. It'll increase costs, it'll increase inflation, it'll increase trading costs, it'll increase capital costs because the majority of euro bonds and currency derivatives are traded through London. And a lot of that business is basically going to Frankfurt now in Paris. So the comparative advantage that London has basically built over the last 250 years to 300 years is basically being thrown out the window due to a populist surge there politically that they want to leave the European Union. It's a total disaster, man-made disaster. Okay, Next. Follow your markets. Next. Ken, did you go next? Jacob, what's going on? Let's hit the pavement. What's up? What's going on?
I did Shanghai also.
Did you? That's okay. Give us any insights. Get market cap, trends, major companies, industry allocations, government policy. Next.
I had the Moscow exchange.
Excellent.
It's down 1.27%.
What's the trend on that?
Declining.
Yeah, you gotta look at it in trend too. What's been going on in Russia? What has Russia been doing? Is Russia in the news every single day? Is Russia a major mineral and oil exporter? Did the Russians basically hack into the DNC and basically compromise our election system? Did Russia basically show aggression and move into Georgia and take the Crimean Peninsula? What's the next aggression that they're gonna do? Did we leave the nuclear agreement, the nuclear pact between us and the Russians? Didn't Donald Trump say we're out? What does that do? When they say we're out, the nuclear pact that was negotiated 20 years ago, what happens when we say we're out? Does it increase or decrease the probability of a nuclear accident? Increases it, okay? This is all tied to the markets, okay? You gotta know all this stuff. Next.
I also did the Mexico exchange.
Excellent, give me more insight.
Went down by 40%, Tuesday.
What?
Tuesday the 12th.
40?
40%.
40% in one day.
It was 0.4.
0.4.
0.4, okay, got it.
Yeah, sorry. And from the previous trading session, and I think the market cap is 402.99 billion.
So what,
Since February 2016.
was it 4 billion, 40 billion,
402.
402 billion? Okay. Kind of gives you kind of an idea of the size of the markets. Okay, next. Do more research, find out, about these countries, find out about their stock markets. The stock markets basically, and the stock market indexes is the leading indicator. Basically all information, since the markets are efficient, all information basically flows into those stock prices and into those indexes. So the indexes are basically a leading indicator of the overall health of those countries. Okay, next, any more? I'm gonna shut it down. You need to come back and see if we can do this experiment again on Friday, okay? So do your research, come in, be ready, and then we should be able to move through the class really quickly, okay? We gotta get through this, all right? Let's do the statistical pretest in the last 15 minutes that we have here. Law of large numbers. Yes.
So the one we just did on the second one was.
That's the one you're gonna be tracking. I want you to continue to do it, and then you're gonna do, you can use the one that you're doing for the fact sheet, okay? You're gonna do 2 established and 2 emerging stock markets, okay? And then you're gonna do 2 established and 2 emerging bond markets, because I want you to see the difference between the two. So basically what you're doing is you're doing comparative political, economic, capital market analysis, okay? And then you can use those fact sheets to show potential employers too. Okay, law of large numbers. Is that what we strive for in big data and analytics? Is large data sets, standardized data sets? So standardized data, large data sets. And what do we want out of those large data sets? What are we looking for? What are we looking for in regards to the distribution of the data? We want what type of distribution? What are we looking for?
Normal.
A normal distribution. If we can do a normal distribution, if the data set's normal, if it's not skewed, then does that increase the probability that we can do a forecast? If the distribution is tight and the median and mode are close to each other, and we got a symmetrical distribution of the standardized data, and can't I also take a 2 standard deviation filtering process and throw out the outliers too, and then recalculate the means? Yeah, I can do that stuff. So the law of large numbers and the normal distributions is what we try to get to in all of our data sets. Because then we can apply the statistics and the statistical applications to get the information to then make investment decisions. Okay, so that's what we're looking for. The arithmetic mean and the geometric mean. The geometric mean, you gotta write the equation in. The geometric mean is what is used as the standard portfolio return benchmark equation. Okay? And why would you use the geometric mean over an arithmetic mean? Why do we use geometric means as opposed to arithmetic means?
Arithmetic means can be pulled by skewed data by a lot more.
And what skews the
Outliers.
data? By the outliers, exactly. Okay. So what I'm trying to do is I'm trying to, again, review and teach you the data analytical techniques that I've learned over the last 25 years in developing product, okay, for financial institutions and pension funds and endowments. There are different types of distributions, so when you look at the data sets that you're working with, you gotta basically graph the data, okay, and look at the distributions. You may actually have to log the data. So I got basically price per share, or I got price per square foot for the real estate that I'm looking at. I wanna log it. I wanna multiply the price by a log function. If I do that, and I basically plot the distributions, it normalizes the data. Then I can do the two standard deviations, filter it throughout the outliers. So the first thing you wanna do when you do the data analysis is you wanna do data visualization and look at the distributions. And look at it and see if it's a normal, exponential, binomial, skewed, or Poisson distribution. Depending on the distribution, you might be able to use some kind of statistical corrective method to basically normalize the distribution to then apply the statistics. Other times, you can't normalize the distribution, so you have to apply specific statistical methodologies that basically are adapted to that type of distribution. So if you go on and you go do a master's degree in finance, or you go on and do a PhD in finance or economics, you're gonna be learning simulations, Monte Carlo simulations. Usually with the Monte Carlo simulations, the first thing that you do is you basically plug into the model what the distribution is. And then you can run the simulations to get the statistics from the data. Okay, so you gotta understand what the distribution is, okay? Because that's gonna determine the statistical applications that you're gonna utilize. Mean, median, mode, show me the equation for the mean, for the median, and show me an example of the mode, which is just the recurring. And then skewness, again, does the distribution skew positive, does it skew negative? I can use a z-score, basically the actual data minus the mean divided by the standard deviation, to basically normalize the distribution using z-scores when I get skewness. And then kurtosis is the peakiness in the data, in the distribution. And leptokurtic is, I got a fat tail, it's skewed with a very long tail. So that's your black swan events, that's your financial crises, where you have these big fat tails. Okay? So when you're calculating what is called value at risk, which all the banks use to basically stress test their balance sheets, they're looking at leptokurtic events and stress testing their balance sheets to see if they have enough liquidity to be able to handle a financial crisis. And that's usually the Fed makes them do that. On page 5, you have histograms, stem, leaf, and box plots. Again, that's data analysis to be able to look at data visualization. Finance is all data, so I don't know how much quant you've taken or what if you get a second concentration in analytics, which I highly recommend, or go do the master's degree in analytics. But it's all about data. And now they're screening a lot of the applicants for financial analyst positions and other types of positions to see if you have advanced Excel skills, pivot tables, HV lookups, that kind of stuff on Excel. And then if you have any SQL Server, Python, R, or Tableau, or some of the other data manipulations. If you have any of that stuff, your resume goes to the top of the pile. The variance and standard deviation, when you hear variance and standard deviation, you're thinking about dispersion. And when you hear a standard deviation and variance, the first thing that should come into your mind is volatility and risk, okay? Because we use the variance and the standard deviations as the measures of volatility and risk. And in the investments class, if you've taken the investments class, you can see in the equations that a lot of the equations, particularly the portfolio equations, we're all using variances and standard deviations in some kind of permutation within the equations. Okay? So it's used a lot. Okay? And then the confidence intervals obviously are going to give you you know, how confident is your forecast, how confident does your data set lie within 2 standard deviations from the mean. Okay, so it's a confidence interval. Page 6, confidence levels. The confidence levels are 99, 95, and 90. If you're in the social sciences or in the physical sciences, dealing with thousands of data points, maybe even in banking and finance, you're using thousands of data points. You're probably going to be using a 99% confidence level to calculate the F statistic for the model and the T statistics for the independent variables within the model. We in the social sciences use a 95% confidence level or 90. Usually what we will do is we will run the T statistics on the independent variables within the regression model. We will run it at both the 95 and the 90, okay? Because we don't know, we might have gotten a random data set, so it might have compromised the T statistic at the 95 level, so when we drop it to 90, it pumps up the T statistic and actually starts to pull out more of the influence from the independent variables effect on the dependent variable, okay? Z, T, and F statistics. The Z statistics is the student. T, we usually don't use that because that's usually used for very small sample sizes. We usually have sample sizes of at least 20 or 30 or 200 or 300. The more the better. And then the T statistic is the test the statistical significance of the independent variable's ability to predict the dependent variable. So in finance, you're forecasting EBITDA growth rates or maybe total returns on the stocks. Those are your dependent variables. Then you're building models, multi-factor models with independent variables in them to help build a model to predict the dependent variable. It's all about forecasting at the end of the day. So the T is the independent variables, and the F statistic is the model itself. It's the model structure. How statistically significant are the 4 variables in the model? How's the model's ability to predict the dependent variable? Let me step back a little bit. T statistics range between positive and negative 2. Usually you'll never get a positive or a negative 2, but anything above 1 indicates some statistical significance with the dependent variable. For the F statistics, I would take at least the lowest I would take is an 8. If I'm getting a 13, that's pretty good. If I get anything well above 13, I probably have multicollinearity in the model, which basically means that multiple variables within the model are highly correlated to each other and the dependent variable. So I'm going to need to throw one out at some point. So the F is the model, the T is the independent variables. The coefficient of variation is the standard deviation divided by the annualized expected return on the portfolio or at the stock level. The risk-adjusted rate of return is the flip to that. It's the expected return divided by the standard deviation. The Sharpe ratio is basically the expected return minus the risk-free rate divided by the standard deviation. And I always get the Jensen and the Trainer mixed up, which are basically the same equations, similar to the Sharpe, but instead of using the standard deviation, you use the beta to get the risk-adjusted rate of return. Personally, I like the risk-adjusted rate of return, the expected return, divided by the standard deviation, because I know the unit of return per unit of risk. When I subtract out the risk-free rate for the Sharpe ratio, I can't do the math in my head. Okay? And the risk-free rate is relatively constant over time, so for simplicity purposes, just chuck it. Okay? Just get rid of it. Okay? So those are important factors. Number 7, or page 7, is the covariance. The covariance is basically the variance divided by the number of stocks. So it's really the average of the variance between the 2 stocks. Variance of stock A, variance of stock B, average. Okay, so it's fairly simplistic. Then the correlation coefficient is the covariance divided by the 2 standard deviations for the 2 stocks. So basically the correlation and the covariance are highly related to each other. But the covariance you use in your portfolio optimization programs. And if I want to build a portfolio of global stocks and or bonds, I want to add stocks and bonds to the portfolio that have low, no, and negative correlation with each other to get diversification. Okay? And don't worry, I'll go over this stuff over and over again, and you can always watch the So a lot of this stuff is really review. That's why I go over it over and over and over again. So it becomes second nature to you. You're like a fighter pilot, right? You practice, and then when you get into a situation where you need to make decisive decisions, the decisions become natural because you totally understand it. It becomes second nature. Okay, that's how traders actually think. The global portfolio standard deviation is not the standard deviation equation, it's the portfolio standard deviation equation. And I want you to write that out, one with the covariance equation at the end and the one with the correlation. Okay, so you can see the two. And obviously, if you get high covariance and high correlation, you're going to get a high standard deviation. If you get low covariance, low correlation, you're going to get low portfolio standard deviation through diversification. 8, value of using the regression techniques. Why is it important to use regression? Why does everybody use it as a standard forecasting method? What's important about regression? What can you use it for? What's the number? To do what?
Prediction.
Exactly, to forecast the future. Is it important to be able to forecast the future? Absolutely. If you can forecast the future, you can mitigate any loss to your portfolio and you can take advantage of market trends. Okay, so regression. Sometimes you don't have enough time series data to be able to run a time series regression, so you would use cross-sectional regression. You could use cross-sectional regression as a first attempt, and then as the data series and the data time series become available over time, then you can use the same factors and switch to the time series. Okay? So the cross-section is a valid methodology, but it also could be an interim methodology until you get the data time series. Okay? Remember, cross-section is the same factors across multiple companies or multiple countries, okay, in one period of time. Where the time series is basically the same factors, but it's one country over time, okay? But you're using the same regression diagnostics. And then how do you determine the dependent and independent variable? Well, they're going to tell you, I need you to forecast basically GDP growth rates for the top 10, global markets. I need you to forecast, where the stock indexes are going to go over the next year or two for the top 10 stock markets. They're going to tell you what the dependent variable is. They may or may not know what the independent variables are to be able to predict the dependent variables. So you're going to have to ask of them what you think the variable should be to predict that variable. Or you ask other people around you, or you ask other people who are experts in that area outside the firm, or you go to the library and you read industry papers and you use industry reports and peer-reviewed journal articles to see what people have done in the past to predict that variable. If you get buy-off internally from your model, that's internal validation. If your model conforms to a certain degree with external research that's been done, that's external validity. And you're going to need that when you get up in front of the board to present your results and your recommendations.
It's behind.
What?
It's behind 5 minutes.
Is it? Okay. So am I out of time?
Yeah.
Okay.
I gotta go.
So continue to work on this. On Friday, we'll continue the lectures on this to set the base. You guys are doing, who's presenting? Awesome. You got chapters 1 and 2?
Yeah.
No, there was 2 teams.
Oh, yeah, someone else.
Yeah, who's team 2? Got it. So you guys are doing this second presentation? Awesome. You guys are good. So you get to keep the economists, you get to keep the